Howdy, Jacob here. Today we're looking at EOG Resources in the oil, gas, consumable fuels industry. 76.6 billion market cap on 74.9 billion enterprise value. It looks like they develop, produce, and market crude oil, natural gas, and natural gas liquids in the U.S. Incorporated in 1985. Okay, so growth has been relatively slow for the last 10 years, but kind of just all over the place. We see that year over year growth has been as high as 99% and as low as negative 48%. So we're looking at a very volatile business here. We're definitely going to be wanting to use averages when we're taking into consideration where we think this company is going to grow over a long period of time. And even the margins are kind of all over the place. On the growth side, low of 38, high of 81. On the operating side, um, low as almost negative 10% and as high as 48%. So we are seeing most recently very substantial both operating and gross margin in comparison to history. We'll see whether we think that can last or not. And recently, very high returns on invested capital. Your balance sheet shows 5.2 billion cash on hand with 3.5 billion long-term debt and 34 million short-term debt. So enough cash to write off all of their long-term and short-term debt. Very comfortable with that. Their cash flow statement shows a little bit of an increase in cash from operations, but an actual decline in capital expenditures with a pretty big increase in free cash flow. But again, you have to look at kind of the averages here, since if you look at just a 1 year period, it's a pretty volatile. It shows pretty volatile, and their use of cash is the dividend, which is a 2.7% yield, pays out over 50% of their 5-year average free cash flow, and their share repurchases is about 20%, and then the rest towards reducing that debt figure. So on the debt side, they are pretty comfortable. Like I said, they have more cash on hand than long-term and short-term debt. So not a concern there, but capital allocation is absolutely important for every single company. And so when you have return on invested capital historically in the 20% range, if they can find ways to reinvest back into themselves to get that 20%, that's likely going to be the best use of that cash. And that's going to be better than buying back shares that are not so cheap or handing it out as a dividend. So you definitely want this company to be reinvesting back in themselves if they have opportunities at substantial rates of return. Otherwise, buying back shares seems to make sense to me. Reducing debt a little bit makes sense, and then paying a dividend. I'm not too concerned with the use of cash right now. I think that obviously I need to look at whether this company is very cheap or not, to whether I want them to be buying back more shares or not. But if they don't have anything to invest in, maybe they have 25% return on invested capital, but they have nothing to invest in, then, I mean, your only options are really acquisitions, debt pay down, dividend, and share purchases. And acquisitions are usually pretty inefficient, and it looks like they don't do that at all. And so for their use of cash to be paying a dividend, maybe their stock's not super cheap, and it might be the best thing for them to do at this point. So let's make some assumptions to see what I think it's worth here. On the revenue growth side, I would not be surprised if it grew roughly 3%. I don't see any reason for an excessive premium on P, price to free cash flow. Margins are pretty solid on an average basis. 20 and 18 look pretty similar. 1% of shares repurchased would be about $760 million. Increase that by their stock-based compensation, you're looking at just under $1 billion. And I think that seems pretty reasonable. That's about a 20% payout of their 5-year average free cash flow towards that. We said about a little bit over 50% on the dividend side. Where have they been going historically with that? Okay, so it looks like it is much higher than it has been historically. I think I'm pretty comfortable increasing that with their revenue growth assumption, just saying that their payout is going to be roughly the same, maybe decreasing to 40 to 50% at the end of 7 years, so they have more capital to possibly buy shares that are stupidly cheap, or maybe at that point make acquisitions that are advantageous to them, or reinvest at hopefully high rates of return. But for now, it just looks like it needs to fall a little bit more than half, and before you get the return I'm looking for here. I do think it's an interesting company, a very volatile one, but if you take the averages here, I do think that I wouldn't be surprised if it got to a point where it looked extraordinarily cheap on an average basis due to the fact that maybe it's going through a tough time at that point. But for now, definitely a bit frothy in my perspective, and we'll just be waiting for it to go to a more attractive price. Thank you, and have a great rest of your day.